lawmakers, and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, President Trump's jolts to global trade have dimmed the prospects for European inflation and the economy. We'll discuss what that means for the ECB with Sören Radde. He's head of European economic research at Point72, also a former ECB economist. We'll take you live to Frankfurt, where the European Central Bank is set to lower interest rates for an eighth time with Lizzie Burden. We'll also discuss the backlash against President Trump's tax bill, Vladimir Putin's latest warning with Ross Matheson, our EMEA news director. So thank you all for joining us. There's a lot to discuss, and of course there's ties between everything. Ross, I find it incredible. Day two, Elon Musk is still really pushing against the tax bill that Donald Trump has put in place. I mean, he says it's killing Trump, or he's pushing Americans to, quote, kill Trump's bill. Another big escalation.
Well, that's right. He's obviously overtly campaigning against this bill at this point, particularly against Republicans. And the question is, does this end in some kind of showdown with Donald Trump? Because the US president is devoting a lot of his time to get this bill through. His hours on the phone in his office, lobbying to get this through the upper house in the US and to do so quickly. And so they are going on a bit of a collision course with each other, even though they're still overtly maintaining that language of not criticising each other directly and personally. There's no way that this doesn't come to a head in some fashion at some point, because this is something that Donald Trump has staked everything on, is getting this bill through, getting his tax cuts done and so on. And, Elon Musk just is out there actively trying to stop it. It shows again how complicated this bill is. It's going to be very difficult to get it all through the Senate properly without a bunch of changes that go back to the House. This bill is getting mired very quickly. We've seen clashes between Musk and Trump before. We've seen them disagree before, but they've still maintained the lack of personal criticism of each other, because in a way they need each other. It's sort of like mutually assured destruction in a way, on a business and financial side. But, does it come to a head, and who's the first one to do it?
Yeah, and Sören, this points to actually a lot of fiscal pressures worldwide. You could see them in certain European countries, but certainly the U.S., where we're seeing that more and more.
That's right, absolutely. I do think, as you say, it's a pressure point in the US. It's a focus point for markets. Less so in the euro area, and I think that has a lot to do with the way that the fiscal impulse that we're expecting is distributed, with Germany taking the lion's share of the fiscal burden here, and Germany has, by all accounts and standards, the fiscal space to do that.
In politics, Ross, when you look at what President Trump has been doing, there's another executive order, and this time announcing a travel ban from at least a dozen countries. It feels like Trump the first time around, because I think he's done something very similar. What do we actually know?
Well, that's right. It is reminiscent of his first term, but as you say, about a dozen countries are on this list: Somalia, Sudan, Libya, Iran. Afghanistan is also a notable one, and that's where he might come in for some criticism, but it's off the back of that attack in Colorado, where there was an Egyptian man who overstayed his visa, and so he's saying it's a response to that. But it's also bound up in this whole environment for him, being very tough on migration in general, the crackdown on student visas on universities, and trying to manage who's coming into the US, and also trying to send people, frankly, back out of the US. This is a list of countries that probably wouldn't surprise anybody. Is it going to be a massive influx in or out? Probably not. But there are some very talented people emerging from these countries, even if they're, countries that have been fragile and underdeveloped, who could be assets to the US from an R&D or a science perspective or so on, or come to universities there and really contribute to the US economy. And those people may not be able to come anymore. But it's more about the overarching message from the US under Trump, which is very tight control of who's coming into the country and who's coming out.
Yeah, and Sören, we'll talk about ECB in a second, but actually to some of these, small points, but important points, it goes to the heart of actually what Donald Trump is trying to do in terms of trade. And it's create a kind of new world order. We don't really know where it ends up, and maybe a lot of things will be broken in between. What does it mean for the world economy, for the U.S. economy and Europe?
I mean, you're right, it goes well beyond trade. Trade is one big aspect of it, but I think, there are shifts in institutional orders. There are shifts in alliances, global alliances. To be seen what it means for the US. We are projecting that growth is going to slow down strongly in the second half of this year on the back of real incomes decline as tariffs affect inflation. In the euro area, there will be a drag, but on the other hand, the political developments have catalyzed, as already alluded to, a fiscal response. And so if you, on a forward basis, I think there's more optimism. And also speaking to what you were just alluding to, Europe, if you will, is an island of stability in a sea of political uncertainty.
Depends on which country in Europe.
It depends on the country. But, by and large, if you look at institutional stability, I think that's the pitch that Europe has to make.
Yeah, and we've talked about this quite a lot to see whether this is a moment that Europe can seize. I don't know whether you'll see, Roz, also Europe trying to play a bigger role in this Russia-Ukraine story, because it does seem like it's Trump dominating headlines, and whether they'll succeed.
Well, they've always been trying to stay in the room on it, and the struggle has been to be in the conversation and to be in Donald Trump's ear on it. And obviously, the German Chancellor, Friedrich Merz, by the way, is in D.C. today, meeting with Donald Trump this evening, so we'll see how that goes. But as Donald Trump, increasingly seemingly walks away a bit from being an active player in trying to resolve the Ukraine-Russia conflict. I mean, he did speak with Vladimir Putin yesterday, but the call was quite inconclusive. And he said himself, this is not a call that was going to lead to peace. Is he leaving others to get on with it? His idea has been Russia and Ukraine should talk directly and continue to talk directly. Leaders should talk directly. This might be an opportunity for Europe to get back into the conversation, certainly continue to support Ukraine militarily and to find ways to buffer Ukraine to hang on, frankly, in the conflict if it's not going to resolve itself quickly.
Okay, so Sören, let's talk about the ECB. Let's go to Frankfurt, where the European Central Bank is set to lower interest rates. Lizzie Burden joins us now. So, Lizzie, the last easy cut, or certainly one that's priced in, walk us through the debate around what comes next.
Well, as you say, Francine, it could be the last easy cut. Easy because it's now 1.9% where inflation is across the euro area. It fell in the May data at the core headline and services levels. But it could be the last easy cut because from here on out, the outlook gets really murky. First, in the short term on the tariff front, because, as you say, we just don't know whether the US is going to raise tariffs on the EU from 10 to 50% at that July 9th deadline. We just don't know how the EU is going to retaliate. And as Roz reminds us, we've got the German Chancellor Friedrich Merz at the White House today trying to calm those tensions. But then there's also the longer-term impact of the fiscal boost on defence and infrastructure spending. We just don't have concrete details yet of what that's going to look like. Maybe we'll get some more at the NATO summit later this month. But because of all of this uncertainty, not only is the ECB today going to publish its updated growth and inflation forecast, they're also going to publish scenarios to try and account for all that could happen. But this is why the question then turns to, do they cut in July again, or do they wait the summer and go again in September? The argument for waiting would be that inflation could go up again. Consumer inflation expectations for the year ahead are at 3.1%, the highest since last February. But the argument against going now is that it could create so much uncertainty in the market if traders think that actually the pause is an end to the rate cuts, and that's the last thing Christine Lagarde wants to do. She does not want to create more surprises in an already volatile market, and so I'm sure she'll keep her cards very close to her chest in the press conference today, and we'll hopefully hear more about her future at the ECB, Francine, because there's been a lot of speculation that she's going to lead the World Economic Forum. She hasn't denied it yet, so I'm sure it's another one that will come up at the press conference.
Oh, I'm sure she'll be asked many times. Lizzie, thank you so much. Lizzie Burden there in Frankfurt. So when you look at the ECB, I mean, there's a number of questions on actually, is there a worry that inflation consistently undershoots for quite some time? And how many cuts are you expecting from the ECB?
Yeah, so obviously the cut today, that's really, if we're honest, a sideshow. I think the main event is the forecast.
It's forward, yeah.
Exactly. Where we are, as Lizzie alluded to, expecting a notable undershoot, so 1.7% in 26, 1.9% headline in 27, and below 2% core inflation forecast as well for both those years. That, in our mind, together with downside risks due to trade and benign inflation prints in May and June, should catalyze another cut. So we're looking for another cut in July.
July.
And then,
that's bold.
Well, they're coming from a cutting sequence where they've gone every meeting. They're probably not going to tell us today that they're cutting in July. They're probably not going to think that they will be cutting in July. But our view is the data will push them there, and just the global environment and the trade uncertainty, which we think will persist beyond July 9th.
Sören, overall, I mean, there does seem to be, the surveys are ugly, but actually it hasn't really translated into bad data in Eurozone or actually elsewhere. Does it take time actually to translate into the real economy, or could the economy hold up?
Certainly. I think there are two things. One, you've got the tariff front-loading effect, and that is very clearly visible in the Q1 numbers. We'll get the breakdown tomorrow, actually, the expenditure breakdown of the Q1 GDP numbers. I expect there was a significant boost from net exports on the back of tariff front-running. Today's German orders print for April already suggests that front-running effect may be fading. And there was some strength in underlying orders, but we haven't seen the tariff effect. That should really still come in the data from May onwards in the hard data.
Ross, what do we know about, I mean, it was interesting to hear, Sören say that actually Europe is relatively stable, which is true in terms of institutions. I mean, question marks in terms of politics. But what do we know about that visit of Chancellor Merz? He got off to a really bumpy start. He seems to be in better hand. But anything they do on defense spending won't actually filter through the numbers in 26 or 27 even.
Well, that's right. But, I mean, Germany has done a lot. I mean, it's a fundamental shift to have lifted the debt brake and to open the ability to spend a lot more. I mean, the challenge for Germany is less having the money. It's how to spend it and how to get through. There's a lot of regulatory issues and things that slow things down in Germany. In a way, it's about freeing that up to allow that money to flow where it's needed. For Friedrich Merz, this meeting with Donald Trump will be an interesting one because, of course, he's probably looking at some other leaders who've traipsed through the White House and had, you'd say, problematic experiences in the minute, because Donald Trump likes to hold court when they're having the start of their meeting. And I'm sure Friedrich Merz has been preparing for all sorts of possibilities to come up in that minute. And again, what is his goals to get out of this conversation with Donald Trump? And what does he want to put on the table with Donald Trump? Probably getting away with the meeting without any issues might be a goal in itself, you'd say, at this point in time. But it's also about showcasing, again, that Europe is stepping up. And that's coming into the idea of NATO soon. Europe is very keen to show Donald Trump, we've heard you, we're listening, we're spending more, we're pushing a lot of money into our own defence to be more self-reliant, and we're taking the burden off you as a result.
So, Sören, if you look at, at all of that, these complex issues, and you're, of course, the expert on the European economy, is this Europe's moment? What can they do, fiscally, from a also policy point of view, to actually, I guess, counter the U.S. but come up trumps? Yeah.
So, like you were saying, the German fiscal package is big, it's bold, it's very un-German in a way. 1.2 trillion over 12 years. That is going to boost German GDP quite considerably. We estimated that it boosts GDP by about 1.5% over the term of this government, and that's probably understating the effect. The plans, the spending targets they're putting forward are more ambitious than what we thought they would be, especially on defense. So there could be some upside surprises there. The issue is a little bit, Germany is not the only game in town in Europe, but is the main game in town by a very large margin. So at the euro area level, we have a boost of about half of that in Germany, which shows you that, that is not matched elsewhere. And I think this is where the question marks are. That speaks to the, NATO summit, the potential 5% commitment to defense spending and how to deliver on that. And my expectation would be we're not going to see short-term fireworks in Europe unless there is an external threat, but it's going to be the long game. But that long game will come.
So interesting. Thank you both for joining us. Sören Radde, there, the head of European Economic Research at Point 72, and Rosalind Matheson, our EMEA News Director. Now, coming up, we discuss M&A in the European media industry. That's next, and this is Bloomberg. now for a topic close to home for us, the media industry. Czech holding company PPF Group recently announced its offer to increase its stake in the German media firm ProSieben as it attempts to oust rival bidder Italy's MFE. Well, joining us to discuss the latest is Didier Stoessel, the Chief Investment Officer and incoming Co-Chief Executive of PPF. Mr. Stoessel, thank you so much for joining us. Look, there's a lot going on, of course, in the industry, in the media. What are you expecting to change for you in the next couple of months?
Good morning, and thank you for inviting me. Yeah, it's always a pleasure to be on your show. For your viewers, probably a lot of them don't know PPF, so I will give you 2 minutes to tell you who we are. We are an industrial investment company. We are family-owned, which means we have a very, very long-term vision of all our investments and very patient capital. We have 5 verticals. Telecom, media, which we will be talking with you for, banking, banking and financial services. We also are very strong in logistics, in the UK and France. In Post, our out-of-home company delivers over 700 million parcels.
Mr. Stoessel, do you think your partial tender offer can be successful, given ProSieben's shares have been trading at or above, actually, €7 in recent weeks?
I mean, when we launched the offer, as you know, the premium was around 20% to the then price on the market. And I think that people also compare offers. If you look at the cash component of our offer, €7 versus the 4.4 euros approximately of MFE, clearly that's again more than 20% premium. So yes, we do believe, we are quite confident. We do believe we also offer an alternative which might suit many investors, because this restructuring or this change or digital changes for the group are not easy to do, which means that it will take time. So people can either cash now or cash partly, or wait with us and benefit from the restructuring that we hope we will be able to launch.
Do you think you'll have to go above €7, or actually do you see a chance to team up with the rival bidder, MFE, at a later stage?
I mean, as you know, our offer is €7, and that's what it is. It's already 20% premium to what the share price was before. And as you know, it's a non-controlling offer. So 20% premium for a non-controlling offer in the German market is absolutely the right one to be. I mean, we always said from the beginning, MFE is there, they have 30%. So by definition, we will have to work with all stakeholders, including them, to make sure that this company goes in the right direction. But they should be welcoming this, because if the company gets better, by definition, they should be happy as well.
But so is it possible that, let's say in a year, you actually team up with MFE and do something jointly? Or is it too soon to think about it?
I mean, it's too soon, for sure. But, as I said, after this offer, we would be both of us at 30%. So by definition, we need to try to work in the interest of the company, in the interest of all shareholders, including obviously PPF, MFE, and the remaining float. So it is clear that we will need on the board to have the right discussion. That's what we said. That's why we said let's have a bit more enhanced presence on the board, so that we can push harder this digital transformation.
What do you think the future of linear TV is, Mr. Stoessel? And given your incoming co-CEO, will you also push for a lot more of a presence in the US, or is there another strategy that you'll pursue?
I mean, we are a European media group, and that's where we will stay. Yeah? If you look outside of the 6 countries where we are in CE, we are also together with Canal Plus in Viaplay. Yeah? And that's a good example. You were asking about MFE and us in ProSieben. In Viaplay, Canal Plus and us are working very closely together and in great harmony. And I think the progress that has been made in Viaplay, which is the sort of Netflix of Europe, if you want to call it like this, have been quite tremendous in the last 1 year. So no, we're a European group. You asked about linear TV. I've never been somebody saying that linear TV is dead. I'm sure you're interested, as we are. We are all working in this industry. I strongly believe that the way the industry is going is the content you are right now producing, or we're producing together, has to be distributed on every medium. One of the medium will be linear TV. One of the medium will be computer screens. One of the medium will be over-the-top platforms. One of the medium will be subscription-based VOD. One of the medium might be your websites or your terminals. So all of this is what media is becoming, which is we are content producers, and we're using all the medium possible in order to get the best distribution and reach. So no, I'm optimistic.
Thank you. Yeah, and we're cross-platform, so this will, of course, also be distributed cross-platform. Didier Stoessel, thank you so much for joining us today. That was the Chief Investment Officer and incoming Co-Chief Executive of PPF. Now, the German Chancellor, Friedrich Merz, will meet President Trump in the White House later today. Merz has veered between boasting about common ground with Donald Trump to bemoaning the U.S. president's volatility and even mocking his bravado. Now they meet for the first time face-to-face. We're joined by Chad Thomas, our Europe Executive Editor. Chad, I'm nervous for him. What can we expect?
Francine, usually when you have these first meetings, they're very ceremonial, and we as journalists are kind of like, there probably won't be that much that happens, but people will be watching very closely today to see exactly what happens when Friedrich Merz is in the White House with Donald Trump. Will there be one of these things where he turns down the lights and shows a video and asks Merz to respond, as we saw with Ramaphosa, something that happened with the Ukrainian president, or will it be a more sort of usual kind of discussion? We're told by Merz's people that he is prepared for all eventualities, and that he has said to his people that he will do everything possible to not get into any sort of an argument with the president. So, we'll all be watching closely to see exactly what happens. I think for Merz, if he comes out of it with there out being some sort of a blow-up, that in a way is already a win.
What are the topics, Chad, likely to be discussed?
I think that you'll certainly have a discussion around trade and tariffs. The German automotive industry, of course, is hugely important to this country. More than 800,000 people work in the automotive industry, and the U.S. market is an absolute key market for German automakers. And of course, President Trump, that is something that he often goes on about, is the German car sales in the U.S. So that will certainly be a topic. I think you also will want to watch to see, does he bring up the far-right populist party here in Germany, the Alternative for Germany party, and whether he says anything about freedom of speech like Vice President Vance did at the Munich Security Conference. So those are some of the key topics that we'll be watching when they speak.
Chad, thank you so much. Chad Thomas, our Europe Executive Editor. Coming up, U.S. Defense Secretary Pete Hegseth in Brussels urging NATO allies to ramp up defense spending. We'll get the latest next, and this is Bloomberg. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. Treasury yields hit a one-month low as a gauge of U.S. services enters contraction, fueling bets that the Fed will reduce rates at least twice this year. The ECB expected to lower rates today, but traders will be looking for clues on future cuts and the impact of trade turmoil on growth. Plus, Trump's travel ban is back. He also warns that Putin has indicated Russia will retaliate for Ukraine's recent drone strikes. Now, U.S. Defense Secretary Pete Hegseth is urging NATO allies to commit to a defense spending target of 5%. Well, let's get straight to Bloomberg's Andrea Palasciano in Brussels. Andrea, thank you for joining us. You're at NATO headquarters, so tell us more about this crucial summit.
So this is the last meeting of defense ministers before the summit in The Hague in just a couple of weeks. And this has been a chance for Pete Hegseth to hammer it home once again. Trump wants allies to commit to 5% spending on defense, which just a few months ago seemed a totally unrealistic demand. But it actually sounds like they are getting there. And today they are signing off on extremely ambitious new weapons targets. And that's going to be the last milestone before they actually make it to the summit. And political consensus has emerged. They have accepted this demand, and they want to keep Trump happy, basically.
So why is it so important for allies to keep Trump happy? Do they worry about retaliation, or do they need the U.S. for something?
The allies absolutely need the U.S. to be committed to NATO, to leave no trace of doubt that the U.S. is fully committed to NATO, simply because the U.S. is NATO's most important member. They bring more than half the military capacity to the military alliance. And most of the enablers, the nuclear shield, most of the things that make NATO the most powerful military alliance in the world actually comes from the U.S. And so if the U.S. isn't fully committed, then the whole construction crumbles, basically.
So, Andrea, of course, the alliance should not directly discuss peace negotiations because NATO is not formally involved, but they will discuss the threat of Russia and the threat that Russia poses to them. What impact will the peace negotiations have on NATO?
It is correct that NATO has zeroed in on Russia as its main threat. Just a few years ago, there were still other threat factors identified, but at this point, NATO is really, really laser focused on Russia. And so whatever happens between Russia and Ukraine will be of the utmost importance to NATO, because this war is the biggest land war since World War II, is literally happening at NATO's borders. And the situation on the border, on the eastern flank, is not that straightforward. There have been incursions, there is increased cyber and hybrid threats reported. And so NATO is really aware of the fact that its border with Russia and with a major conflict zone is actually quite fragile.
Andrea, thanks so much, as always. Andrea Palasciano there in Brussels. Now, money managers showing renewed interest in Europe as a destination for investment, with many seeing the region as an area of relative economic stability compared to the U.S. Let's take you live to Berlin, and join Bloomberg's Kriti Gupta for day 2 of the Super Return Conference. Kriti, over to you.
Francine, thank you so much. As you said, we are here in Berlin at the Super Return Conference, where Europe is a question mark a little bit. There's so many folks here who are really bullish on Europe. They're saying that this is the moment for Europe to finally shine. Others are saying, well, maybe this is just a tactical term when it comes to allocations. And you still have to be thinking about where the capital markets actually are in the big scheme of things. I have the perfect guest to talk about both of those topics. Caillaux over at General Atlantic. He's the co-president and head of EMEA there. Joins me right here in Berlin. Thank you so much for joining us.
Thanks for having me.
Of course. Let's talk about these capital markets here. We had this conversation a little less than a year ago that 2025 was supposed to kind of be a reawakening for private markets. They were finally going to pick up in terms of deal making and see these exits. What happened?
Oh, listen, I think there's a bunch of different trends that are happening, and I got to tell you, I'll start by saying we're mostly optimistic. I think in your question there's kind of two aspects, is what's happening to the public markets, and that's a topic I know you and I have debated over and over again, and in a way it's kind of failing mid-market tech companies. Because if you look across the different European markets, there's almost no representation of tomorrow's industries and technology, right? Whether it's 0.3% at the FTSE or 5% at the DAX, it's really underrepresented. And the bad side of that is it creates a lot of tension and access to capital for great companies. The good side of that, with an optimistic hat on, is for the private markets, it means our opportunity set is much bigger than it's been in the past. One of our biggest competitors has always been the IPO market. And as it's failing this segment of the market, we're jumping into that and finding unbelievable deal opportunities.
But is there pressure on that? I mean, isn't the go-to phrase in private markets that when you're looking at the deal, you got to look at the deal exit as well. But how much visibility is there on that side of things?
It's definitely been a disruption. If you take a long enough period of time, we've kind of always equally exited companies out of strategic sale to a later stage investor, or the IPO. And the truth is, since the 22 correction, the IPO markets have been completely unpredictable, right? I can't remember a time in my career where IPO markets were shut over this long period of time. And so it does make it harder to think about liquidity, in particular for, I would say, very large cap companies or companies that need big access to capital. The flip side of that is we're a very creative industry. I think we're going to find other ways to get liquidity. That message is very clear from our LPs that after a period of massive investment, it's time for us to return capital. I think we feel let down by the IPO markets, and now it's a chance to build liquidity elsewhere.
The consensus idea, I think, when it comes to the public markets at least, is that volatility is here to stay for years, perhaps. What do you do in that environment? Is the playbook to just kind of hold on to the assets longer, or is it to lean into the volatility? What do you think?
Listen, the problem with volatility is it's kind of the death of capital formation, right? When volatility spikes, you see public markets shut down, and private markets struggle as well to deal. As I said, that's been our biggest opportunity in the new deal-making front, because we've taken advantage of volatility, honestly, to price deals in a way I hadn't seen in almost 20 years. So it's been a really appealing market. I think when it comes to public capital formation and creating liquidity, I think we're going to have to resort to either new forms of liquidity, whether that's the secondaries market, or, to your point, holding on to great assets. If you think about that opportunity for investors, why not hold on to your best assets? I'm a huge believer that private capital is a better product for our investors. We've delivered alpha, but it's a better product also for entrepreneurs. The type of companies we invest in are growing 30-40%. We help them with that. Public markets penalize them for not doing things. And so I think there's a natural and healthy aspect to longer duration in privates. Of course, LPs need to sign up to that.
Let's talk about how that all applies to Europe specifically.
Yeah.
Europe's having this incredible moment. It's attracting so many fund flows in the public and the private markets as well. Walk us through how long that lasts.
This is an interesting question, because I don't think it's this big of a massive I see this more as a rebalancing than a huge shift. And in our markets, which are really driven by innovation, it's hard to ignore the amount of innovation coming out of the US. But I do think what you're seeing a lot of investors realize, and it's something that's been present for years, is after this perception of US supremacy, right? What they've realized is actually European markets are cheap compared to the US. Whether it's the public markets where Europe is at a 30-40% discount, you see the same thing happening in private markets, even though the fundamental trends behind them are just as strong. Now, we don't have strong GDP growth, we don't have the same rhythm of innovation, but we're still the second largest consumption bloc in the world. And we're somehow in a lot of trends behind what you've seen in the US and in China, and people are playing catch up on that theme. So I haven't seen yet, at least in our private markets, this complete shift of exposure from US to Europe. What I do see is people realizing that actually Europe is a nice risk return compared to other markets.
But even in that rebalancing, there are still trillions, frankly, in terms of going to Europe as well. And I'm curious what that does in terms of absorption when it comes to Europe. There's only so many deals, one would argue, in terms of being able to catch up with that kind of demand. And I'm curious if there is a question here of either higher valuations or simply the idea that maybe there's a potential liquidation of kind of longer duration assets in the long term. How does that show up? Could there be a scenario, not too distant future, where there's too much supply and not enough demand?
We haven't seen that yet, and I always try to remind people that as big as the private equity industry's become, we're still tiny compared to public markets, right? We're an 8 to 10 trillion industry if you're generous. Public markets are 130 to 140 trillion. And so we're very small. And as I said earlier, I think we're a superior product for companies. I don't know why we shouldn't be gaining market share against publics as entrepreneurs choose their capital source. So I'm a big believer that private markets are going to continue to grow. I think your question is, there's also a tactical aspect to this, which is if there's a huge influx of capital around European deals, how does that supply-demand balance continue to move? I think the appealing part of the market right now, and if I was an LP committing capital, I would look at why are deals being won by private equity investors? And the subtle change that's happened from 21 to today is companies are not selling themselves to private equity anymore. They're looking for partners. Like the discussion we have with entrepreneurs and CEOs is, how do we convince them we're the best partner for their company? And that debate allows us to differentiate ourselves a lot more and kind of protect ourselves against this risk of overcapitalizing a certain market. I think in other markets that's not the case, right? I think the intermediated market has become highly competitive again, which is a little bit surprising given the volatility you're seeing in publics.
A little bit of cautious optimism over at General Atlantic is what I'm hearing.
Maybe.
Gabe Caillaux joining me right here in Berlin at Super Return. Talk to us a little bit about what that allocation looks like. Is it that moment in the sun for Europe? Does it last? He says it might be a little bit of both. Francine.
Kriti, thanks so much. Great job out there. Kriti Gupta with the very latest, of course, from Super Return. Now, it was no ordinary Wednesday for gaming fans in New York. They spent the day, some of them spent the day waiting for the Nintendo Switch 2 to go on sale at midnight. Now, the console is the first major release by the company in over 8 years. With most of Nintendo's revenue tied to the console's success, the pressure is on to ensure another blockbuster. Well, Bloomberg Originals takes a closer look.
It's hard to overstate how important the Switch is for Nintendo. Almost all of its revenue comes from this one product, or the exclusive games the company develops for it. Its popularity since 2017 has driven Nintendo's share price to an all-time high. And everything's riding on the Switch 2, keeping that trend going.
The stakes were very high.
Nintendo is at the most successful point in its history.
And here's why. The Nintendo DS, 154 million sold. The follow-up 3DS, 76 million. The Wii, 102 million sold. The follow-up Wii U, oh dear. And the Nintendo Switch, almost the best-selling console of all time, 152 million sold. No pressure then.
Switch 1 created a very high hurdle for the future consoles to surpass.
So Nintendo's breaking new ground with some very subtle shovels.
It's the first console in Nintendo's history that is kind of the same thing, but just a little bit bigger and a little bit better.
That strategy belies decades of corporate lessons learned sometimes the hardest way. But this time, the stakes are just too high for history to repeat itself.
Well, subscribers can watch that documentary on the terminal and Bloomberg.com and, of course, on the Bloomberg Originals YouTube channel tomorrow. Now, for more on Nintendo, let's bring my fellow gamer, Charlie Wells. Charlie, so first of all, I mean, this feels very significant. I know it'll probably be on Christmas lists and, birthday lists, but how significant is it?
I mean, Francine, literally as you and I are sitting here speaking, there are consumers across the world who are lining up to buy the Switch 2. They have been waiting for hours. They've been looking forward to this for months. And a lot of the excitement that we're seeing today outside these brick and mortar stores, we've been seeing in the share price of Nintendo over the past few months. So this year, Nintendo's share price hit the highest point ever. And recently, in recent days, it's been kind of flirting with that high point as well. And this is a huge moment for Nintendo because their revenue growth has been slowing over the past few quarters. And so they really need this to be a blockbuster. We're in early hours right now for this launch, but so far it's looking pretty good for Nintendo.
Okay, I know you and I will try it shortly, but in what ways is the Switch 2 launch showing us how firms are navigating the trade war?
This is what is interesting beyond gaming, right? Because literally, Nintendo's fortunes have been so linked to free trade, to globalization, to global trade. If you think about the day that Nintendo announced the prices for the Switch 2, that date was April 2nd. I think we all remember April 2nd was also the day that Donald Trump announced global trade tariffs. And so, Nintendo shows us kind of how firms have been kind of trying to navigate potential price pressures here. One strategy early on that they deployed that they have said that they could maybe change is keeping that core Switch 2 price the same, $450 in the United States, but rising the prices of accessories around it. So that is one strategy we're seeing some firms deploy as they navigate these tariffs.
Okay, I think last time I played anything was like a Nintendo Game Boy.
At an arcade?
Yeah. Charlie, thank you so much. I know it's a really big deal in terms of business and money. Charlie Wells there with the very latest on the Switch 2. Now, coming up, we're in conversation with Fortescue's Andrew Forrest as the mining executive turns his attention to saving the oceans. That's next, and this is Bloomberg. Now, mining and shipping amongst the biggest contributors to global emissions, but one mining leader is really trying to clean up the industry. Australian miner Fortescue is aiming to eliminate all emissions, both in mining operations and in the shipping of minerals around the world. We're joined by Andrew Forrest, the executive chairman of Fortescue and founder of the Minderoo Foundation. Now, he made his wealth on land, but has really turned his attention to saving the seas and even has a PhD in marine ecology. Andrew, thank you so much for joining us. I love our conversations because you're always so passionate about what we should be doing and always so frustrated by what we're not doing. So you've been a long-time opponent to deep-sea mining. If you look at a lot of the things that, is getting serious, is that one of your main worries? I mean, it feels like, again, it's back.
Yeah, look, probably not a priority. It's switching off the heavy polluting part of shipping to completely environmentally friendly fuel. It's protection of all the marine life in the water column. And then, of course, deep sea mining. It's a complete farce. Thinking you can mine the land bed with atmosphere above it with different rules to make sure you're ecologically responsible. You can put it back the way you found it. Could be different, but it won't be worse. Or the seabed with the water environment. The land bed and the seabed should be treated exactly the same. If you can't do the ecological longitudinal studies like over several years like we have to do in mining, don't complain. Don't say, well, it's not economic. That's your fault, mate. Don't think you can just go and rape and pillage and leave the destruction to everyone else just because you whinged about not being environmentally responsible like we have to be on land.
Yeah, and Andrew, I know you've also funded this pretty incredible movie by David Attenborough, showing, how basically the oceans are being destroyed. But do you think it's getting worse? There was, I guess, a humanity, level of consciousness. Is that getting worse because of the Trump administration and some of the things that they're pushing through?
Yeah, I mean, there's just a monumental short-sightedness. I mean, if you're acting for your people, if you're acting for every American, you want to turn the oceans from scarcity, where they are now, they're going over a cliff, with ocean biomass, with fish populations. It's literally going over a cliff, Francine. So if you want to arrest that scarcity, which is coming at you like a freight train to every single American, every single European, every single person, if you want to arrest that scarcity and turn it to abundance, then you have to do the simple economic, commercial steps to protect it and to make sure those oceans become flourishing. And if you protect the big secret, which is revealed by David Attenborough in our film, is the big secret of the miracle of the oceans. If you preserve 30% of your oceans, you can literally fish the other 70% forever. I mean, it's like a bank account which never runs out, or an ore body. You keep 30% of your ore body, you can mine the other 70% forever.
Is there the will to do that? Because there's also trade tariffs, and I'm going to ask you about, copper, iron ore. It just feels like there's a lot that people are anxious about. So where do you think the leaders' priorities on some of these things are?
All I can say, Francine, if you're a leader without a business brain, peril for your people. Okay, absolute peril, because business drives everything. Now, responsible business is regulated by responsible leaders. So if you don't protect 30% of your oceans ecologically, and you are willing to let the 100% just disappear because you didn't realise there's a proper commercial business reason to protect the 30%, then you're betraying your investors' faith in why they elected you.
How's the UK doing? I mean, I know you have big investments here.
Yeah, we have very large investments here. Look, I'm saying to the UK, I'm saying to the EU, I'm saying to North America, saying to Australia, the science is now resolute, it's inarguable. Protect 30% of your oceans, you'll have flourishing oceans for the rest of humanity. Don't do it, we're going to exhaust them and extinct them.
I know you also always have great thoughts on, the world economy, rare earth and things like that. Where are we right now? Early June, do you worry that it's all going to go wrong, given the uncertainty, the fact that chief executives don't really want to spend, and actually the fact that trade is now because of allies, not, economic sense?
Okay, so that's a very broad question, Francine. Look, I'm completely convinced that you can fool some of the people all the time, or all the people some of the time, but you're not going to get away with all the people all the time. And so people know tariffs are not a tax cut. People know it's an imposition, it's inflationary, it will cause economic distress. Fine. If you want to do that for your people, that's fine. But that truth is going to come out in the next year or two, because you've already got escalating prices in North America. Yep. You've already got goods and services becoming scarcer. It's not working. So go back to free enterprise, go back to free trade, protect human rights, absolutely, and protect your environment. They're great investments. I mean, these are great investments. any business person with half a clue are going to know this is a good investment.
I mean, when you look at the energy transition, but also AI, we need more copper, we probably need more lithium, and some of the materials that are used in this transition. What does it mean for Fortescue?
Look, I've been approached by two countries, which I shouldn't mention, who have enormous copper deposits and other deposits, enormous lithium. I don't think lithium's so sexy these days because we're watching other technology, just using salty water, looking really sexy. But let's just keep to it. Countries which have big deposits of this, and they've approached me to say, could you lead us into a responsible mining industry which is fully green, and at the end of mining, we won't really be able to tell it's been mined? And I said, yes, I can. So I have no doubt that the world has abundant copper, abundant anything on land without having to go and destroy the oceans.
So are you diversifying into copper? I mean, look, iron ore has definitely fallen from the highs. I know you put a big bet on green hydrogen, and that's being a little bit delayed compared to your ambitions.
Well, look, I put a big bet on going green. And so green hydrogen, all that happened is that people decided, because, that we had like hundreds of millions of bots just blasting through Europe and North America saying, hey, now's not the time to be considering anything uncertain. Look at your cost of living. Let's worry about this. Let's stick with what we know, oil and gas. That was just one big fraud on the people. If you want to lower your cost of living and increase your standard of living, you go green. And so, but people like us, people like me, are the people responsible. It's not you or everyone watching this show. You should be able to consume, travel, do what you want, but you've got to hold people like me to account. I want green steel, Forrest. Don't give me your dirty iron ore anymore. I want to be able to ship my goods knowing that I'm not harming the environment. The cargo pays for the ships, nothing else, not the fossil fuel. The cargo. People who want to travel, they should be demanding, listen, we want to know when we fly there's no harm.
But it's at a cost, right, to you. So how many people have a conscience?
Is it R&D is normal. I hear this number that it's going to cost $2 trillion to convert. Well, wow, okay. What do you think you're spending, planet, on fossil fuel a year? Oh, a couple of $1 trillion. So what we're talking about is like a year payback. I mean, it's just ridiculous. The reason why we're not is an expense. It's that the fossil fuel sector and weak politicians are just saying, let's just do nothing. Isn't that great? And no, it's not great. Actually, you're there to lead. If you say you can't do it, get off the stage and let in someone who can, because you'll be right, you can't.
Who do you think is the best leader in this?
Oh, look, I'm not going to
choose a favourite.
I'm not going to choose a favourite. Thank you, Francine, for the question.
Talk to me about LNG, because you're planning to import gas into Australia, but it's one of the top LNG exporters. So how will that work?
Okay, so that is a very large facility which sits in the middle of Australia's industrial area, basically saying there is no need for future 50-year life oil and gas projects, which are going to cost 20, 30, 40, 50 billion, end up being a big cost to the taxpayer, huge environmental consequence. This is sitting there saying, you want to do that? I'm going to switch this on. I'm going to bring in cheap gas from overseas. Your project's going to be unviable. And so it sits there, literally as a conductor, saying, okay, as soon as Australia needs extra energy, we're going to switch it on. As soon as we possibly can after that, we're going to be using it for hydrogen. So it's a facility which is already paying dividends.
So interesting. Andrew, I could talk to you for another 5 hours, but you have a job to do. And we have to go to break. Andrew Forrest, Executive Chairman of Fortescue and founder of the Minderoo Foundation. Coming up, the U.S. House Speaker Mike Johnson will appear on surveillance a little bit later. That conversation is at 12:30 p.m. London time. Up next, we look at Japan, the U.S., and of course Europe. Bloomberg Brief. That's next, and this is Bloomberg.